Well, some risk markers are suggesting markets could pull back and hard. If history repeats itself, markets could maybe fall 27%. Welcome to the Daily. My name is Jessica Amir, market strategist with Mumu. So what is going on? Well, firstly, global investors are adjusting their portfolios, preparing for high interest rates and a potential Donald Trump win in 2 weeks. Beneath the surface, the risk indicators are suggesting things could turn ugly. The US government bond yields have moved up to 4.2%. That's a 3-month high, while the US dollar has marched up and oil prices are up too, extending their run. They're now up 4% in 2 days. And the technical indicators are also suggesting the broad S&P 500 index is looking overbought. Just note that the last time that we saw bond yields this high, and we had similar patterns forming in the S&P 500 index, then we saw markets fall about 27% on average. That's looking back at what we've seen over the past 3 years. It hasn't always been the case, though. Do note, though, that investment bank Citi has started to warn clients that markets could potentially pull back 10%. So will a sell-off occur? Well, it might not happen. Of course, big tech companies are rolling out their earnings over the next couple of weeks, and they could deliver better than expected surprises, and that might support the market. Maybe we'll see stronger than expected results from Apple, Microsoft, and Nvidia. Perhaps their earnings could save the day. But we do need to pay attention to what is happening beneath the surface and what happens when markets fall. Remember that when markets do fall, we do see investors buying the dip. But this time, dips could be bought a little bit quicker because we do have the US and China cutting interest rates and stimulating their economies. Plus, we also have company earnings growing stronger than expected. Also, remember, markets don't go up in a straight line. The S&P 500 has always recovered from a crash, though, and investment banks do a lot of their buying when markets fall. So that's a consideration. Let's move to the finer detail now. Well, the Russell 2000, which is a measure of the small cap index, that's fallen 2.5% in 4 days. While we have seen investors buying into gold exposure and gold stocks, and that's also another reason why the gold price is up 33% this year. But wait, the silver price is up 46% this year. But the factors are there now suggesting that more upside is ahead of us for gold. But do consider investors are still buying into tech stocks. The Nasdaq 100 specifically continues to move up. It's up for the consecutive 4th straight day. Perhaps investors are expecting high tech earnings and outlooks. Also note that investors are continuing to buy into China-facing stocks. We're seeing Lululemon up in the US, up 2.5% in 2 days. Royal Caribbean also listed in the US. Their shares are tipped to benefit from not only China's fresh rate cuts, but also US rate cuts too. Down under, what do you need to consider? Well, yesterday we did see the Aussie share market seeing its biggest one-day pullback in 7 weeks. Yesterday, the ASX 200 lost 1.6%. It's rising ever so slightly today. It's up by about 0.25%. But what's happening is bond yields are skyrocketing. The US, or rather the Aussie bond yield, is now paying 4.4%. So that tells us that investors are preparing for high interest rates in Australia. And so we've got a bond yield and bond ETFs paying higher yield than the average Australian share market's dividend of 3.6%. That means that the broad Australian share market could be contained in terms of their gains from here on in. But of course, beneath the surface, there's always a bull market somewhere. We are seeing plenty of gains in commodity stocks. Just look at Westgold Resources. Their shares are up 26% in 5 days. Regis Resources up 15%. Evolution Mining up 11%. West African Resources also up 11% in 5 days. Also consider coal stocks, perhaps some call them dirty coal stocks. They're moving up higher too. That's because the coal price is up 15% from its September low. Guess why? Well, China is now importing a record amount of coal from Australia because its economy is in turbocharge mode from its biggest ever stimulus package on record. And that's the Daily.